There is a number sitting at the center of a $2 trillion industry. It is not a real number. Nobody traded it. Nobody discovered it in a market. A small group of professionals inside private firms produce it once a quarter using models they built themselves, with assumptions they chose themselves, and nobody on the outside is legally required to verify it. That number is the value of your pension fund's newest investment. And here is the thing. As long as nothing goes wrong, the number works perfectly. Everyone gets paid, everyone looks smart, the reports go out, the investors are happy, but no one actually knows what happens to that number when something does go wrong. Because it has never been tested in a real crash. Not once. Not in the entire history of this market at its current size. That is not a conspiracy theory. That is the Federal Reserve's concern, the Bank of England's concern, the IMF's concern, and yet the money keeps flowing in. Let us go back about 15 years. It is 2008. The global financial system just collapsed under the weight of its own complexity. Banks had packaged bad mortgage loans into instruments so layered and so opaque that even the banks themselves could not tell you what was inside them. The crash happened fast. Publicly traded assets fell in real time. You could watch the numbers drop on a screen. It was brutal, it was visible, and it was impossible to ignore. After that, regulators did something logical. They made banks more careful. They raised capital requirements. They added stress tests. They forced the big institutions to hold more cushion, take less risk, lend more conservatively, which created a gap. If the big banks were stepping back from certain types of lending, who would fill the space? The answer was someone with less regulation, more flexibility, and a very compelling pitch. Enter private credit. Private credit is not complicated in theory. A private fund raises money from investors, usually large institutions like pension funds, insurance companies, university endowments. It then lends that money directly to companies, usually mid-sized businesses that either cannot access public bond markets easily or prefer the speed and flexibility of a private deal. No stock exchange involved, no public pricing. The loan is negotiated in private, held in private, and valued in private. In 2010, the global private credit market was worth roughly $300 billion. Today it is somewhere between $1.5 and $2 trillion, depending on who is counting and what they are willing to include. That is not growth. That is a transformation. Private credit has gone from a niche corner of finance used by specialists to one of the primary engines of corporate lending in the developed world. Blackstone, Apollo, Ares, Blue Owl. These are not household names to most people, but together, firms like these now manage more lending activity than many of the largest banks on earth. The pitch to investors was elegant. You give us your capital, we lock it up for several years, and in exchange, you get higher yields than public bonds and lower volatility than public markets. Higher returns, lower risk. What is the catch? The catch is the number. When you invest in publicly traded stocks or bonds, the price updates constantly. Markets are pricing your assets in real time, incorporating new information every second. When something bad happens to a company, the market reacts. The price moves. You see it. It is uncomfortable, but it is honest. Private credit does not work that way. When a private fund lends money to a company, that loan does not trade on any exchange. There is no market price. So how do you tell investors what the loan is worth? You model it. The fund's own team, using their own assumptions, their own discount rates, their own view of the borrower's health, produces a valuation. That valuation is reported to investors quarterly. It is called mark-to-model as opposed to mark-to-market. And here's where it gets interesting. Academic research has shown that private credit valuations are strikingly smooth. Quarter after quarter, the reported values barely move. Even during periods when public credit markets were showing significant stress, private credit portfolios were reporting almost no volatility. Now, there are two ways to interpret that. One interpretation is that private lenders are genuinely more careful and their portfolios are genuinely more stable. The other interpretation is that the model does not update fast enough to reflect reality. That the smoothness is an artifact of how the number is produced, not a reflection of what the assets are actually worth. That second interpretation keeps some very serious people up at night. Let us talk about the companies on the other side of these loans. Private credit overwhelmingly serves what the industry calls the middle market. These are businesses with revenues roughly between $50 million and $1 billion. Not large enough to issue public bonds easily, not small enough to be irrelevant. Many of these borrowers carry significant debt loads. Private credit deals often involve leverage ratios that traditional banks would not approve. The loans are typically floating rate, meaning the interest payment adjusts with prevailing interest rates. Between 2022 and 2023, interest rates rose faster than at almost any point in modern history. For a middle market company with a floating rate loan, that meant their interest burden increased dramatically, sometimes doubling, in the span of 18 months. The private credit industry's response was largely, "Our borrowers are resilient, our structures are strong, our default rates remain low." And the reported numbers supported that claim. Default rates in private credit stayed remarkably contained even as borrowing costs surged. But researchers began noticing something else. The number of companies receiving payment-in-kind treatment was rising. Payment-in-kind means the borrower cannot pay the interest in cash, so instead, the interest gets added to the principal of the loan. The debt grows instead of shrinking. The company is technically not in default. The loan is technically performing, but the borrower is not actually paying. In public markets, that dynamic would immediately be reflected in prices. In private credit, the loan stays on the books at close to face value. The number does not move. Now, step back and look at who is holding these assets. Pension funds, insurance companies, sovereign wealth funds. These are not reckless speculators. These are institutions that exist to meet long-term obligations. Pensions need to pay retirees. Insurance companies need to pay claims. Over the past decade, these institutions massively increased their allocations to private markets, including private credit, precisely because of that promise of stable returns and low volatility. At the same time, private credit funds are structured with something called limited liquidity. Investors typically cannot pull their money out quickly. Capital is locked up for years at a time. That is usually fine, until it is not. The scenario that concerns regulators is not a single dramatic collapse. It is something more gradual and more confusing. Imagine that economic conditions deteriorate. The actual quality of private credit portfolios starts declining, but the reported numbers do not fully reflect it yet because the models update slowly. Investors, looking at their statements, see stability. They feel comfortable. Meanwhile, public markets are pricing in the stress clearly and immediately. Public assets are falling. Institutions that need liquidity sell what they can sell. They sell their public holdings. That accelerates the decline in public markets. Private credit, which cannot be sold, stays on the books at its modeled value. The portfolio looks diversified and resilient on paper. But the resilience is partially a function of how the assets are measured, not how they are performing. This is what the Bank of England called valuation uncertainty. It is what the IMF flagged in its financial stability assessments. It is not an obscure technical footnote. It is a structural feature of how this entire market operates. There is a quiet irony at the center of this story. One of the main selling points of private credit has always been its separation from the chaos of public markets. No daily price swings, no panic selling, no contagion from irrational market sentiment. And that is genuinely valuable in some ways. Long-term illiquid investments can produce real returns. Removing the noise of short-term market sentiment is not inherently dangerous. But the absence of a market price does not mean the absence of risk. It means the risk is hidden. Hidden not necessarily through fraud or deception, but through the fundamental nature of how these assets are valued. The number exists in a state of permanent uncertainty. It represents a best estimate produced under conditions of limited information, using methods that have never been stress-tested at scale during a genuine economic contraction. The industry has grown from $300 billion to nearly $2 trillion without ever experiencing a real recession at this size. The people managing these funds are not careless. Many of them are among the most sophisticated investors in the world. But sophistication is not the same as certainty. And when the people at the top of the Federal Reserve, the IMF, and the Bank of England are publicly asking the same question, that question deserves to be taken seriously. Here is where we end up. The private credit boom is real. The capital is real. The loans are real. The returns, so far, have been real. But somewhere inside every fund report, every quarterly valuation, every portfolio statement sent to every pension fund and insurance company holding these assets, there is a number. That number has never been asked to prove itself in the worst conditions. It has lived its entire life in a period of extraordinary growth, cheap money, and, until very recently, low interest rates. The stress test is coming eventually. Every credit cycle ends. Every economic expansion eventually turns. When it does, the most important question will not be which companies default. It will be whether anyone actually knows what these assets are worth. And the uncomfortable answer, sitting quietly at the center of a $2 trillion market, is that we will only find out when it is too late to ask.